NIO stock just took a beating on Wednesday. Shares plunged almost 9%, closing at about $5.72, after the company announced a major equity raise. For investors, the headlines were jarring. More than 180 million new shares hitting the market, priced at a discount to Tuesday's close. It's no surprise the stock sold off hard. But as painful as the drop feels in the short term, it's important to step back and consider what this move actually means for NIO in the bigger picture. Tonight, we're going to unpack the details of the offering, why NIO is raising cash now, what risks it creates, and why, with the right execution, it might still strengthen the long-term story. Let's start with the hard numbers. On Tuesday, NIO closed at $6.28 after a modest gain. By the close of trading Wednesday, it had fallen to $5.72, down more than 55 cents or nearly 9%. At its worst point during the session, the stock traded as low as $5.54. That's a sharp move, especially on heavy volume. More than 230 million shares changed hands, triple the normal daily average. The catalyst was NIO's announcement of a public equity offering, 182 million shares, with underwriters holding an option to purchase an additional 27 million. What really stung for investors was the pricing. The shares were offered at a discount of about 11% compared to Tuesday's close. That's typical in an equity raise. The discount is meant to entice big institutional buyers to commit capital. But for existing shareholders, it felt like a gut punch. Dilution is never welcome, and when it comes at a double-digit discount, the reaction tends to be swift and negative. So why would NIO do this now? The company actually ended the second quarter with about $3.8 billion in cash on hand. That's not an empty bank account. But NIO also has big plans and big expenses. Management has been clear. They expect to burn about $1.6 billion this year as they continue to ramp up operations. And while the goal is to hit positive free cash flow by 2026, the company needs capital to bridge the gap. This offering raises more than $1 billion in fresh funds. That money will go toward research and development for smart EV technologies, expanding the battery swap and charging infrastructure, and shoring up the balance sheet. Here's where the cautiously bullish view comes in. This is not a distressed raise. NIO isn't scrambling for survival cash. It's actually taking advantage of relative strength. Remember, the stock had rallied more than 60% in the past 3 months, fueled by record deliveries, Analyst upgrades, and excitement over new models like the Onvo L90 SUV. That rally gave NIO room to raise money from a position of momentum, rather than waiting until conditions were worse. From management's perspective, this was an opportunistic move. From shareholders' perspective, it's painful dilution, but dilution that may fund long-term growth. The near-term risks are obvious. Existing shareholders now own a smaller slice of the pie, and the discounted price means per share value took an immediate hit. That's why we saw such a sharp sell-off. There's also a risk that the market perceives this as a signal of weakness. If NIO really had plenty of cash, why raise more? The answer is scale. In an EV market where giants like BYD and Tesla are slashing prices and investing heavily, standing still is not an option. If NIO wants to keep competing, it needs the firepower to fund R&D, expand the swap network, and push into new markets. That's where the long-term opportunity lies. If this billion-dollar raise is deployed effectively, it could accelerate NIO's push into profitability. The company has already shown progress. In the second quarter, revenue came in at $2.7 billion, beating expectations. Losses narrowed to $567 million, better than what analysts had feared. Gross margins ticked up to 10%, an improvement in a brutal pricing environment. And deliveries have been climbing, 72,000 in the second quarter, up 26% year-over-year, and a record 31,000 in August alone. These aren't the numbers of a company in retreat. They're the numbers of a company scaling, and scaling fast. But scaling requires capital, and that's why NIO is making this move. Yes, dilution stings today. But if those funds lead to new models, more customers, stronger infrastructure, and ultimately positive free cash flow, the long-term value could outweigh the short-term pain. Now let's zoom in on the investor psychology. The past 3 months have been euphoric for NIO bulls. The stock rallied more than 60% from its lows, fueled by excitement over the Onvo L90 SUV, anticipation of the third-generation ES8 launch at NIO Day 2025, and consistent delivery beats. That optimism left the stock vulnerable. When a company riding high suddenly announces $1 billion offering at a discount, It feels like the air getting let out of the balloon. Some of Wednesday's drop was pure profit-taking. Traders who had enjoyed big gains used the headline as an excuse to lock in profits. That's not necessarily a bad thing. Markets don't move in straight lines. Pullbacks are part of the process. For longer-term investors, the key is whether Wednesday's drop changes the fundamental story. And the answer is, not really. The equity raise adds dilution, yes, but it also adds strength. It funds growth, reduces reliance on debt, and signals that management is confident enough in demand to keep investing aggressively. If the story was strong at $6.28, it's arguably stronger now, because NIO has more cash to execute. Let's talk technicals for a moment. Wednesday's plunge took the stock down to 554 intraday, before it recovered slightly to close at 572. That creates a new near-term support zone in the mid-550s. On the upside, $6 remains the psychological battleground. If NIO can reclaim 6 and hold it in the coming sessions, it would suggest the equity raise sell-off was more of a reset than the start of a breakdown. If it can't, and if shares slip further into the $5 range, traders may grow cautious. But it's worth noting the massive volume on Wednesday, more than 230 million shares. That kind of washout often marks capitulation, the kind of day where weak hands are shaken out and stronger hands step in. So, what should investors watch for next? First, the details of how NIO intends to deploy the new funds. Management has outlined R&D, infrastructure, and general corporate purposes, but specifics matter. The more clarity investors get on concrete projects, the easier it will be to see this raise as strategic rather than desperate. Second, analyst reactions. Citi, Bank of America, and others have been supportive, with buy ratings and price targets above $7 or even $8. Will those views change after the dilution? Early signs suggest not. Most analysts see this as a logical move given NIO's growth trajectory. Third, delivery updates. September's numbers will be critical. If NIO maintains momentum and stays on track for its 89,000 Q3 guidance, investors will have reason to look past Wednesday's sell-off. Finally, we can't ignore the broader context. The Chinese EV market remains hyper-competitive. Price wars are real, margins are under pressure, and macroeconomic headwinds, slowing growth, weaker consumer spending, fading subsidies, are all challenges. But NIO has a few unique advantages. The battery swap ecosystem is a true differentiator, offering convenience and recurring revenue through subscription services. The multi-brand strategy, luxury with NIO, family SUVs with Onvo, compact EVs with Firefly, positions the company to compete across segments. And upcoming catalysts like NIO Day 2025 could reignite excitement around the brand. So here's the takeaway. Wednesday's plunge hurts, no question. An 8 to 9% sell-off in a single day is brutal. But it's not the end of the NIO story. It's a reset, a reality check after a strong rally, and an opportunistic move by management to raise capital while the stock price was relatively elevated. If NIO executes on its promises, new models, delivery growth, margin improvement, and infrastructure expansion, the dilution from this offering could look small in the rearview mirror. For now, cautious optimism remains the right stance. Acknowledge the risks, accept the volatility, but recognize the long-term potential. NIO has stumbled before and bounced back. The path to profitability is still a few years away, but Wednesday's equity raise may actually help shorten that journey. As always, this isn't financial advice. Do your own research, weigh the risks, and decide how much volatility you're comfortable with. But don't mistake Wednesday's sell-off for the end of the road. For it may just be another step in a long, winding climb.